Welcome back to another edition of Griffonomics, where we strip down the complex machinery of the market and see what's really ticking under the hood. I'm your host, and today we are doing something a little different on the deep dive.
A lot different, I think.
Yeah. Usually when we talk about corporate turnarounds or, strategic pivots, we're looking at something that feels, well, logical.
Right. It's usually an evolution, a step to the left or a step to the right.
Exactly. The drill a software company moving into hardware, maybe, or a brick-and-mortar retailer finally getting its act together with e-commerce. You can see the thread connecting point A to point B. It makes sense.
It's rarely a leap off a cliff hoping to grow wings on the way down.
That's a perfect way to put it. But today we are looking at a transformation that is so bizarre, so counterintuitive on the surface, that if you saw it in a movie script, you'd probably toss it in the trash for being unrealistic. We are talking about a company that spent 40 years, 4 decades, as the undisputed king of home karaoke machines, the singing machine.
Oh, yeah.
I mean, if you grew up in the 90s or 2000s, you probably had one. Or your cousin did. They were absolutely everywhere.
I think I still have one in my attic, actually. The one with the built-in disco lights?
That's the one. Iconic. And today, that same company has sold literally everything. Every microphone, every speaker, every licensing deal with pop stars to become a pure-play artificial intelligence logistics firm.
It's staggering.
We are going from Sweet Caroline to supply chain optimization, from karaoke parties to complex cargo routing.
It really is the ultimate Phoenix or Ash scenario, and I've been covering the space for a long time. This is one of the most extreme pivots I've ever seen in the microcap market, and I don't use the word extreme lightly.
No, I believe it. So we're talking about Algorhythm Holdings, ticker symbol RIME, RIIE.
Right.
And the mission for this deep dive is to generate a granular, no-holds-barred investigative report on this company.
Right.
Because on one side, you have this revolutionary technology that is supposedly solving a $1 trillion economic black hole called the empty mile.
A truly massive problem.
And on the other side, you have a financial structure that, frankly, looks like a horror movie for equity holders. I mean, we're talking about death spiral financing, massive dilution.
And a race against time that is essentially a coin flip between bankruptcy and becoming a unicorn. There's really no middle ground here.
So we've got a stack of documents here that is terrifyingly thick. We're talking 10 Q filings from the third quarter of 2025, S1 registration statements that just dropped, earnings call transcripts, investor presentations, and some very, very interesting independent analysis we found online. We are going to go through all of it.
Let's do it.
So buckle up. We are going from karaoke to cargo. Let's unpack this. I want to start with the strategic inflection point. That single moment where the company decided, okay, no more microphones, we are done with entertainment. This happened in August 2025. It feels like a fever dream, but they actually pulled the trigger.
August 1st, 2025. That was the day the music died, literally. They executed a divestiture of the singing machine business to a company called the Stingray Group.
Okay, so let's break that deal down. Because when you see the numbers, it starts to paint a picture.
It really does. They tell a very specific story about why this happened. They sold the entire legacy business for $4.5 million.
Which, for a brand that was a household name for 40 years, doesn't sound like a massive windfall. I mean, $4.5 million. You see luxury condos in Miami selling for more than that. It feels small.
It isn't a lot of money, and the structure of the deal is even more telling, I think. They only got $500,000 in cash up front. $500,000.
That's it for the whole company.
That's the cash component. The rest, about $4 million, was just Stingray agreeing to assume liabilities. So think, like, accounts payable, maybe some debt on the books.
So let me get this straight. They basically paid someone, or rather gave the business away, just to have someone else take the debt off their hands.
Essentially, yes. It wasn't a sale in the traditional sense of maximizing value. It was an extraction. They were looking for a clean break.
So they were desperate.
You have to understand the context of the consumer electronics sector over the last few years. It has been brutal. Just absolutely brutal. Margins are razor thin.
And you're competing with giants.
Exactly. You're holding massive amounts of inventory that depreciates every single day it sits in a warehouse. You're dealing with shipping costs, warehousing costs, returns from big box retailers like Walmart and Target. It's a cash-intensive, low-margin grind.
And the singing machine was struggling with that.
They were bleeding. Management looked at the balance sheet and realized that if they wanted to pivot to this high-tech AI thing, they couldn't have this anchor dragging them down. They needed to eliminate the hardware inventory risk and stop the cash burn.
So it wasn't about making a profit on the sale.
Not at all. It was about stopping the bleeding so the patient could survive the surgery that was about to happen.
It's like cutting off a limb to save the body.
Or burning the ships so there's no retreat. It's a point of no return decision. Once that sale closed, they were no longer a consumer electronics company, period. And they moved fast. They immediately rebranded from the ticker MICS, which was cute, for microphones, to RIME for Algorhythm Holdings.
I noticed another detail in the proxy statement that I think is worth dwelling on for a second.
Yeah.
They moved states. They reincorporated from Delaware to Nevada. Now, usually when I see companies move to Nevada, my spidey sense tingles a bit. Why make that move right in the middle of a pivot like this?
That is a fantastic catch, and it's a very calculated legal maneuver. Delaware is the gold standard for corporate law, right? Most of the S&P 500 companies are incorporated there for a reason.
Sure, stable, predictable.
But Nevada is generally seen as offering much stronger protections for directors and officers, especially during periods of high volatility or high risk.
Protections against what exactly?
Lawsuits. Specifically, shareholder derivative suits. When you are about to engage in high-risk financing, which we'll get to, or, the stock price might be incredibly volatile, Nevada law makes it significantly harder for shareholders to sue management for business decisions that might go south.
It raises the bar for liability.
By a lot. It basically says that as long as the directors aren't committing outright fraud, they're protected from being sued over a bad business outcome.
Which is convenient, considering the risk profile we're about to discuss. It feels like they were putting on armor before going into battle.
Precisely. It signals that management knows they are entering a turbulent phase. They are building a fortress around the boardroom while they try to pull off this transformation. So now, legally and structurally, Algorhythm is just a holding company for one primary asset. SemiCab.
SemiCab. Okay, so this is the new engine. This is the AI logistics platform they acquired, or rather, consolidated, back in May 2025. So let's leave the karaoke machines in the past and look at what they're actually building.
Let's do it.
Because the problem they are claiming to solve, this empty mile issue, is absolutely staggering when you look at the data. I think people outside of logistics don't realize how inefficient the world is.
It's almost impossible to comprehend. It is the single biggest inefficiency in the global supply chain, and it's hiding in plain sight.
The CEO, Gary Atkinson, he uses this airline analogy on the earnings calls that I think is perfect for visualizing this.
It really is. He says, imagine you go to the airport and 1 out of every 3 commercial flights takes off with absolutely 0 passengers.
Just an empty plane.
Just an empty plane flying from New York to London, burning thousands of gallons of jet fuel, pilot on the payroll, flight attendants serving nobody.
The airline would be bankrupt in a week. I mean, the ticket prices for the occupied seats would have to be astronomical to cover that kind of waste.
Exactly. No airline on Earth could survive that. And yet, that is standard operating procedure for the trucking industry. The data is clear. The American Transportation Research Institute says 25% to 30% of all truck miles driven in the U.S. are deadhead miles.
Deadhead miles. So that means the truck dropped off a load and is just driving empty to the next pickup or back home.
Correct. Empty. Moving nothing but air.
And we aren't talking about small change here. The numbers are huge.
No. We are talking about $100 billion wasted annually just in the United States. That's just the U.S. Globally, it's a $1 trillion problem. And that's not even touching the environmental impact. The CO2 emissions, you have millions of tons of carbon being pumped into the atmosphere to move air. It's an economic and environmental disaster.
Okay, so that's the problem. It's huge, it's expensive, it's wasteful. So enter SemiCab. They call their solution orchestrated collaboration. Now, I have to be honest, when I hear collaboration and AI in the same sentence, I usually reach for my wallet to protect it.
Yeah, it's a classic buzzword salad.
It sounds like buzzword soup. But digging into the patent info and the tech specs you sent over, this seems fundamentally different from what we think of as a standard digital broker.
It is very different. And to understand why, you have to look at how a standard digital freight broker works. Think of the big names like Uber Freight or Convoy. They've raised billions in venture capital.
Right, they're the big players.
And they operate on a load board model. It's one-to-one matching. You have a load, I have a truck, we match, transaction done. It's basically Tinder for trucks.
Okay, but what's wrong with that? That sounds efficient. I have a need, you have a supply, we trade.
It's efficient for that single transaction, that one leg of the journey, but it doesn't solve the network problem. It's a local optimization, not a global one.
What do you mean by that?
Well, once I drop off that load for you, I'm still stuck looking for the next one. I might have to drive 200 miles empty to get to the next match. The app helped me find the first load, but it didn't plan my week. It didn't solve my empty mile problem.
Right. The app doesn't care about my return trip. It just cares about the immediate fee for that one match.
Precisely. SemiCab is doing what they call multilateral matching, and this is the key. The AI isn't looking at one truck and one load. It's ingesting data from the entire network and clustering demand, even from competitors.
Wait, competitors? Unpack that for me. That seems completely counterintuitive. Why would competitors ever agree to share their shipping data?
This is the secret sauce. This is the whole game. Let's use a simple example. Let's say you have company A. Maybe it's a beverage company like Coke shipping product from Chicago to St. Louis on a Monday.
Okay.
And you have company B, maybe it's a paper company like Kimberly-Clark shipping product from St. Louis back to Chicago on a Wednesday.
All right, I'm with you.
Normally, those two companies don't talk. They certainly don't coordinate logistics. They are operating in their own silos. They both hire trucks that drive one-way full and one-way empty.
Right. They're each paying for the round trip, even if they only use half of it. The cost of that empty return leg is baked into the price of the full leg.
100%. SemiCab's AI ingests the schedule for both companies. It sees the pattern that the humans working in their silos completely miss. It strings those two otherwise separate trips together into a continuous, efficient loop for a single truck.
So the truck takes Company Soda down to St. Louis, hangs out for a day, and then picks up Company B's paper towels to bring back to Chicago.
And the truck never runs empty. It's constantly moving product, constantly generating revenue.
And they claim this eliminates, what was the number?
Over 70% of those empty miles in the networks they manage. And critically, this is the number that matters for the trucking companies, it pushes truck utilization, the amount of time the truck is actually making money, from the industry average of less than 65% up to 85% or even 90%.
That is a massive jump in efficiency. I mean, that changes the entire economic model of a trucking business.
It fundamentally alters it. It's almost like they are creating a virtual private fleet that is shared among different, even competing companies.
And the pitch must be irresistible.
It is. Shippers pay less because they aren't subsidizing the empty drive back, and carriers earn more because their trucks are full more often. It's a classic network effect. The more companies that join, the more data the AI has, the more efficient the loops become, which attracts more companies. It's a virtuous cycle.
It sounds like the holy grail of logistics. But, and there's always a but with these stories, we have to talk about how they are actually executing this. Because when I looked at the outline of their business segments in the 10Q, it seems like they're running two completely different companies under one roof.
You've hit the nail on the head. This is the tale of two business models, and it is absolutely crucial for anyone looking at this company to understand the difference. If you just look at the top-line revenue, you miss the entire story, you miss the risk.
So let's start with where the money is coming from right now. That flashy 12,273% growth we saw in the headlines. It's all coming from India.
All of it. This is the SemiCab Managed Services segment.
Managed services. Okay, what does that mean in practice?
It means that in India, Algorhythm isn't just selling software. They're acting as the freight provider. It's a managed services model. So when a big company like Asian Paints needs to move product, they call Algorhythm. And Algorhythm handles everything.
So Algorhythm goes out and actually pays for the trucks. They pay the drivers. They secure the capacity up front.
Exactly. They are renting the trucks. They are taking on the liability of the shipment. They expanded their fleet from 140 trucks to over 450 trucks in 2025. They are buying the capacity so they can control the network and feed the AI.
But that sounds expensive and risky. If you are paying for the truck, you own the risk if it sits empty for a day.
It is incredibly expensive. And that brings us to the catch. This model is asset heavy. You have to pay for the truck whether you fill it or not. And right now in Q3 2025, they reported a negative 20% gross margin on this business.
Negative 20%. So let me be clear. For every dollar they bring in, they are spending $1.20. They are actively losing money on every single shipment they manage.
Roughly, yes, it's a huge loss because they are in the building density phase. They are paying for trucking capacity up front to prove to the big clients like Unilever and Asian Paints that the network works. They need the trucks on the road to generate the data to feed the AI.
It's a loss leader strategy on a massive scale.
It is. It's like buying 1,000 empty seats on an airline just so you can guarantee availability to your first few corporate clients to get them to switch their loyalty programs. You burn cash now to own customer later.
So they're building this giant money-losing operation in India. What's the end game there?
Well, they're doing this to power India's National Digital Freight Exchange, or NDFE. The Indian government is pushing hard to modernize its logistics infrastructure, and SemiCab seems to be a core engine behind that. So the volume is there, the top-line revenue growth is real, but the profits, they're completely non-existent. In fact, it's a cash incinerator right now.
Which explains why they are so desperate to launch the second part of the business, SemiCab Apex. This is the U.S. model.
This is the holy grail. This is the entire bull case for the stock. SemiCab Apex launched in late 2025, and this is totally different. This is pure SaaS software as a service.
So no trucks.
No trucks, no drivers, no fuel costs, no liabilities. They are selling the AI platform as a white label solution to U.S. third-party logistics providers, or 3PLs, and big enterprise shippers who already have their own private fleets.
So they basically go to, like, a Walmart or a Pepsi and say, hey, you already have 1,000 trucks. Use our software, our brain, to make them run 30% more efficiently.
That's the pitch, exactly. And the economics of software are beautiful. It's asset light. The projected gross margins on Apex are 90% to 95%.
95%. Okay, now I see the strategy. It's a two-step plan. They're using the India business, the dirty, low-margin, capital-intensive, heavy-lifting business, to prove the tech works and build the case studies with huge branding.
Right, it's the laboratory.
Then they take that proven tech and sell it as high-margin, asset-light software in the U.S. to save the balance sheet.
That is the master plan. The India operations are the lab. The U.S. operations are the bank. The problem is, can they survive long enough to sell the software? Because when we get into Section 4 of our deep dive, the financial realities, things get ugly fast.
Let's get into it. Let's look at that Q3 2025 report. As we said, the headline number was dazzling. Revenues surged 1,273% year over year to $1.74 million. If you just read the press release, you'd think this company is a rocket ship.
But it's an optical illusion. You have to remember, the previous year, this segment didn't exist for them. They were still selling karaoke machines. So that growth is just the result of acquiring and consolidating the India business. It's growing from a base of virtually zero.
It looks impressive on a chart, but context is everything.
It's the classic acquisition accounting bump. It's not organic growth in the traditional sense.
And when you look past that shiny revenue line down to the cash on the balance sheet, oh boy, that's where the illusion completely shatters.
It's a full-blown liquidity crisis. As of September 30, 2025, they had only $2.84 million in cash.
$2.84 million. For a public company operating internationally with hundreds of employees and a fleet of 450 trucks to manage, that is nothing. That is payroll for a few months, maybe. That's one bad quarter away from zero.
It's fumes. They are running on fumes. And remember, the India business operates at a negative 20% margin right now. So they are burning cash on operations every single day just to generate that revenue.
Which means that cash pile is shrinking fast.
Very fast. And this isn't just our interpretation. The company's own auditors put it in writing. The 10Q filing explicitly states a substantial doubt about their ability to continue as a going concern for the next 12 months.
Going concern, let's stop there. For anyone listening who doesn't live and breathe SEC filings, that is the auditor's formal way of saying, we think this company might go bankrupt.
It is the reddest of red flags. If you see that phrase in a filing, you stop and you pay attention. It basically means the auditors looked at the bank account, they looked at the burn rate, they looked at the liabilities, and they said, the math doesn't work unless something changes immediately.
And it's not the only red flag in that section of the filing, is it?
Not even close. Management themselves admits that their internal controls over financial reporting are ineffective.
What does that mean in plain English? Because internal controls sounds like boring accountant talk, but it usually hides something scary.
It means their accounting department is understaffed and potentially sloppy. They're not keeping up. They specifically mentioned a lack of staff for journal entry segregation.
Which means?
It means the same person might be able to create a journal entry and then also approve it. It's a basic separation of duties to prevent fraud or errors. It's accounting 101.
And the other one was even more concerning to me. No three-way match for revenue recognition.
This one is terrifying for a logistics company. A three-way match is standard procedure. You have a purchase order from the customer, you have a receiving document or a proof of delivery, and you have the invoice you send out. All three have to match before you recognize the revenue.
So you can prove the service was ordered, delivered, and billed correctly.
Exactly. In a business where you have thousands of individual freight transactions every month, not having a robust three-way match process is it's a massive risk. It opens the door to errors, to overpayments, or even to fraud.
So they could be paying for ghost trucks? Or recognizing revenue for shipments that never even happened?
Theoretically, yes. Or they could be recognizing revenue in the wrong period, which messes up the growth metrics. It tells me that the back office hasn't caught up with the ambition of the front office. They are moving so fast to grow revenue that they haven't built the infrastructure to count it properly and safely.
And that creates a massive risk for investors who rely on those financial statements to be accurate.
It calls the integrity of the numbers into question.
So let's recap this section. We have a company with almost no cash, losing money on every shipment in India, with shaky accounting controls, and auditors formally warning of potential bankruptcy. Why on earth would anyone touch this stock? It sounds like a sinking ship.
Well, that brings us to Section 5, the bull case. Because despite everything I just said, despite the financial horror show, some of the biggest, smartest, most sophisticated companies on the planet are signing multi-million-dollar contracts with them. And that is the paradox of Algorhythm Holdings.
This is the validation piece. This is the other side of the coin. You can fake a press release, you can hype up a story, but you can't fake a contract with a company like Unilever.
Exactly. In January 2026, so just last month, they announced a $1.6 million expansion with Unilever. Now think about Unilever. They have teams of PhD-level logistics experts who do nothing but analyze supply chains all day long.
Right, they're not easily fooled.
If they're using SemiCab to support their global load more, travel less sustainability strategy, it means the tech actually works. It means they tested it, they piloted it, and it delivered real, measurable savings.
And Asian Paints, that's another big one, especially in that region.
Massive. One of India's largest and most respected companies, they expanded their engagement to 183 active lanes under what is now a $6 million annual contract. We're also seeing names like Apollo Tires, Procter & Gamble, Kellanova, the spinoff from Kellogg's.
These aren't mom-and-pop shops. These are global conglomerates.
These are blue-chip validators. They don't mess around with vaporware. They do extensive due diligence before they integrate a new technology platform into the core of their supply chain. It's too risky otherwise.
So the argument from the bulls is,
yeah,
what? That the tech is so good, it will eventually overcome the terrible balance sheet.
That's the argument. The technology is world-class. The customers prove it. The revenue run rate, even with the negative margins, hit about $10 million exiting 2025. That's a 300% increase year over year. They are targeting $20 million ARR by the end of 2026.
So the growth is there, the customer validation is there.
Yes. So if, and it is a massive, massive if they can fix the balance sheet, the underlying asset, the technology itself, is incredibly valuable.
It sounds like they have a Ferrari engine inside a rusted-out chassis that's on fire.
That's a perfect analogy. The engine is powerful, but the wheels might fall off before they cross the finish line.
And speaking of wheels falling off, let's talk about the financing. Because fixing the balance sheet, that is where the villains of the story enter. We need to talk about Section 6, the death spiral and dilution.
This is the part of the story that keeps investors up at night. To keep the lights on, to pay for those trucks in India while they wait for the U.S. software sales to kick in, Algorhythm turned to what is often called toxic financing, or a death spiral.
And they did a deal with a lender called Streeterville Capital.
Correct. And when you see a name like Streeterville in a microcap filing, it's rarely a good sign for the existing shareholders. It usually signals desperation.
Why is that? What do they do?
They provide capital when traditional banks or venture capitalists won't touch a company, but the terms are punishing. The debt they hold is convertible into stock, but it doesn't convert at a fixed price.
Which is
It's everything.
Okay.
The debt converts at 90% of the VWAP, the volume-weighted average price of the stock, over a certain period.
Okay, let's unpack that mechanism because this is the death spiral. I want everyone to understand exactly how this works mechanically because it absolutely destroys equity value. Explain it to me like I'm 5.
Okay. Let's imagine the stock is trading at $1. Just a simple, round $1. Streeterville wants to convert, say, $100,000 of the debt they are owed into shares so they can sell them on the open market and get their cash back.
Right. They want to get paid.
Because of the contract, they get to buy those shares at a 10% discount to the market price. So even though the market says the stock is worth $1, they get their shares for 90 cents.
Okay, so they have an instant 10% profit baked in just by converting. Risk-free profit for them.
Instantly. So they now have a big block of shares, about 111,000 of them. What do? They usually sell them immediately to lock in that profit. They flooded the market with sell orders.
Which, because there's suddenly more supply than demand, drives the stock price down.
Exactly. So now the stock drops to, let's say, $0.80. A few weeks later, they want to convert another $100,000 of debt. But now the price is 80 cents, so their 10% discount means they get the shares for 72 cents.
So for the same amount of debt, they get even more shares this time.
Way more shares. Now they get almost 140,000 shares. So they sell those shares, the price drops to 60 cents, rinse and repeat.
It's a feedback loop of destruction. The more they convert, the lower the price goes. The lower the price goes, the more shares they get next time, which means they have even more to sell, which drives the price even lower.
That's why they call it a death spiral. And the dilution numbers in the S1 filing are staggering. They have registered over 10 million shares for resale just for this financing.
10 million shares. And what's the total share count right now?
It's complicated because it keeps changing, but based on the last filing, exercising all of this could result in potential dilution to existing shareholders of nearly 400%.
400% dilution. That is catastrophic. That means if you own 1% of the company today, and this plays out fully, you might end up owning just 0.2% of the company. Your slice of the pie just vanishes.
It evaporates, and the market sees this coming. It's not a secret. It's in the filings. That's why the stock is down about 96% from its highs, trading near that critical $1 mark.
And they are fighting to stay on the NASDAQ, which is a whole other battle.
They already did a massive reverse split.
They did, back in February 2025. A 1-for-200 reverse split. That is one of the most desperate moves a public company can make.
Explain what that is.
Basically, the stock price was so low, likely trading in fractions of a penny, that they needed to get it back over the NASDAQ minimum bid price of $1. So they just glued 200 old shares together and called it one new share. It doesn't create any value. It's just financial engineering to hide how much value has been lost.
And it's a temporary fix at best.
At best. And they're still under a mandatory panel monitor from NASDAQ. So if they drop below $1 again for any sustained period,
they risk immediate delisting. And if they get delisted, they go to the OTC markets, the pink sheets. Institutional investors can't touch them there. Raising capital becomes even harder. It's a perilous position.
And just to add a cherry on top of this chaotic Sunday, there's a lawsuit. Because, of course, there is.
The Blue Yonder lawsuit. This one is particularly awkward because in their investor presentations, RIME touts Blue Yonder, a major supply chain software company, as a key partner. They put their logo right on the slide deck.
So they're presenting them as a happy collaborator.
Yes, but court documents show that Blue Yonder actually sued them for $509,119 in inherited liabilities from the SemiCab acquisition.
So the partner is actually suing them for $500,000 in unpaid bills.
It appears so. It's just another drag on that already tiny cash pile. It's another leak in a boat that's already full of holes.
So let's zoom out. This is a lot to take in. We have world-changing tech validated by Unilever and Asian Paints, a massive market opportunity with the empty mile. But we are fighting against a toxic debt structure, a critical cash crunch, flimsy internal controls, and legal battles. It really is a binary outcome. It feels like there is no middle ground here.
That's the verdict. This is Section 7. This is a speculative, high-risk binary hold. It either goes to the moon or it goes to zero.
Okay, let's paint the picture for both scenarios. Let's start with Scenario A, the Phoenix. How do they pull this off? How do they escape the death spiral?
Scenario A is that the U.S. Apex sauce platform launch is a smash hit. They sign up a few major U.S. 3PLs or enterprise shippers in the first half of 2026. They need those white label sauce deals, and they need them fast.
Because that's where the high margins are.
Exactly. If they get those deals, the high margin revenue starts flowing in. Remember, 90–95% gross margins on that software. That cash can then be used to cover the cash burn from the managed services business in India.
So the U.S. profits subsidize the India growth until that operation reaches enough density to become profitable on its own.
Precisely. If they can generate enough of their own cash, they don't have to keep drawing down from Streeterville. The stock price stabilizes, maybe even starts to rise on the good news from the U.S. Then they can pay off the rest of the toxic debt with cash instead of stock.
The dilution stops.
The dilution stops. They survive. If they do that and they fix their accounting weaknesses, you own a piece of a company that is solving a trillion-dollar problem and is probably only trading at a tiny market cap. It's a potential multi-bagger. It could be the investment of a lifetime.
Okay, that's the dream. Now let's talk about scenario B, the ash.
Scenario B is that the U.S. Apex sales take too long to materialize. You have to remember, enterprise software sales cycles are long. They can be 6, 12, even 18 months. Big companies move very slowly.
So if the cash runs out before those sales ramp up,
Then the death spiral kicks into high gear. They have no choice but to keep pulling money from Streeterville. Streeterville converts everything they can. The stock gets crushed down to pennies. They get delisted from the NASDAQ.
and the equity goes to zero,
The equity gets completely wiped out. The company files for bankruptcy.
what happens to the technology in that scenario? Doesn't just disappear, does it?
No, the tech will survive. It's
Yes.
too valuable. Someone, maybe one of their big customers like Unilever, maybe a competitor like Blue Yonder or Uber Freight, will buy the assets, the patents, the code out of bankruptcy for pennies on the dollar.
So the technology will live on, but the current shareholders get wiped out. They get nothing.
Zero. It is a race against time. Can they scale the high-margin U.S. revenue fast enough to outrun the debt conversions?
That is the only metric that matters right now.
It is. Forget the India revenue growth numbers. That's a vanity metric at this point. Watch for U.S. SaaS partnership announcements. Watch the quarterly cash burn rate. That's the whole story.
Yeah. And the second thing to watch, I think, is whether they can fix those material weaknesses in accounting. Can they hire a proper CFO and build a real finance team?
That's a huge signal. If they can get their house in order, it shows they're serious about being a sustainable public company and not just a speculative story.
So what does this all mean for the average listener, the person who is just trying to understand the market and find interesting opportunities?
It means you are looking at a classic microcap battlefield. This is not an investment for the faint of heart. This is not something you put in your retirement account. It's a venture capital bet that happens to be trading on the public market. It requires deep due diligence and a stomach of steel.
A legacy karaoke company trying to solve a global logistics crisis while fighting for its own financial survival against a ticking clock. You couldn't write a better drama.
It's absolutely fascinating. It's why we watch the markets. These are the stories that are just incredible.
I want to leave everyone with a final thought on this. We often look at companies and we ask, is the product good? In Algorhythm's case, the product, the technology, seems to be excellent. The validation from blue-chip customers is there. But the financial structure is the product's worst enemy.
It's a great reminder that a good company and a good stock are not always the same thing. You can have a world-changing invention trapped inside a broken corporate structure. The success of the tech and the success of the stock are two different bets right now.
When a company solves a trillion-dollar problem but trades like a penny stock, the market is either missing a gold mine or spotting a landmine. In Algorhythm's case, it might be both.
Well said. That sums it up perfectly. It's both, at the same time.
That's it for this deep dive. Risk defined, portfolio protected. Thanks for listening.
See you next time.